welcome to the 105th Monetary Policy Committee press conference. The Monetary Policy Committee held its 105th meeting a week earlier than planned to deliberate on recent macroeconomic developments and assess emerging risks to the inflation and growth outlook. Among other things, the committee deliberated on recent global and domestic developments and how these have impacted macroeconomic conditions since the last meeting. A summary of the assessment and the key considerations that inform the committee's decision on the stance of monetary policy is provided below. The global environment has changed dramatically since the January 2022 MPC meeting, reflecting new geopolitical events that have further heightened uncertainties. In particular, the Russia-Ukraine war has further challenged global growth recovery efforts. Global growth currently faces downside risks, including the effect of the war on commodity prices, addition of more strain to supply chain bottlenecks on manufacturing output, withdrawal of monetary policy stimulus in some major advanced economies, and vulnerabilities associated with rising debt stocks, especially in emerging market and developing economies. The updated World Economic Outlook report by the IMF projects a decline in global growth from 5.9% in 2021 to 4.4% in 2022. This growth downgrade excludes recent developments of the Russia-Ukraine war, and further moderation of projected global growth estimates is likely under prolonged conditions of the war. The elevated global price pressures have persisted, driven by sharp increases in food and crude oil prices and supply chain disruptions. The war has exacerbated these price pressures and pushed energy and commodity prices to record high levels. As a result, headline inflation across several advanced and emerging market economies has moved above targets, prompting monetary policy responses to help prevent inflation from becoming embedded. The U.S. Federal Reserve Bank has, for the first time since 2018, raised its policy rate by 25 basis points to 0.5%, and with further guidance that it will step up its incremental policy adjustment by 50 basis points if inflation becomes endemic. The Bank of England has also raised its policy rate by another 25 basis points in the year to 0.575%. Similarly, policymakers in several emerging market and developing economies have moved towards policy tightening in response to rising inflation and currency pressures. The shift towards less accommodative policies by major central banks to contain inflationary pressures has resulted in tighter global financing conditions. The US dollar has strengthened. Long-term bond yields have risen in response, and sovereign bond spreads have widened, especially for emerging market and frontier economies, leading to capital flow reversals and currency pressures. These global developments are likely to affect the domestic economy through the trade and financing channels. On the domestic front, the rebound in economic activity continued, as reflected in some improvements in the bank's updated Composite Index of Economic Activity, although at a slower pace than in 2021. The index recorded an annual growth of 4.2% in January 2022 compared to 13.9% and 3.4% in the corresponding periods of 2021 and 2020. The key drivers of the index during the period were industrial production, exports, credit to the private sector, and air passenger arrivals. Consumption of goods and services and construction activity, however, slowed down acting as a drag on the index. The bank's business and consumer confidence surveys conducted in February 2022 revealed a softening of sentiments, with business confidence declining by a greater extent. While consumer confidence dipped by 0.7 percentage points, business confidence declined by 9.6 percentage points. Consumers were mainly concerned about persistent increases in fuel prices, increases in transportation fares, and rising inflation. Businesses, in addition to these factors, were also concerned about the impact of these on macroeconomic conditions and on their short-term targets and profitability for 2022. These survey findings were broadly in line with observed trends in the February 22 Ghana Purchasing Managers Index. The PMI, which is a measure of the rate of inventory accumulation by managers of private sector companies, declined below the 50 benchmark on the back of weak output and purchasing activity amidst rising inflation. Notwithstanding the sustained growth momentum, rising food prices, upward adjustments in petroleum prices, and its effect on transport fares and exchange rate depreciation pass-through have pushed up inflation to 15.7% at the end of February 2022, 5.7 percentage points outside the medium-term target band. Food inflation jumped sharply from 12.8% in December 2021 to 17.4% in February 2022, while non-food inflation jumped from 12.5% to 14.5% over the same period. Also, underlying inflation pressures have increased, signaling broad-based price pressures. The bank's core inflation measure, defined to exclude energy and utility prices, increased from 11.8% in December 2021 to 13.6% in January 2022, and further up to 15.4% in February 2022. Similarly, weighted inflation expectations comprising consumers, businesses, and the financial sector also picked up significantly over the period. Provisional data on budget execution for 2021 indicated an overall broad fiscal deficit, cash, excluding financial sector cleanup costs, of 9.7% of GDP, against the program target of 9.4% of GDP. The corresponding primary balance for the period was a deficit of 8.9 billion cedis against a deficit target of 8.7 billion cedis. Over the year, total revenue and grants amounted to 67.9 billion Ghana cedis, below the projected 72.5 billion Ghana cedis. Total expenditure amounted to 110.4 billion Ghana cedis, below the program target of 113.8 billion Ghana cedis. These developments impacted the stock of public debt, which increased to 80.1% of GDP at the end of December, compared with 76% of GDP at the end of December 2020. Of the total debt stock, domestic debt was 181.8 billion Ghana cedis, while the external debt was 170 billion Ghana cedis. Growth in total liquidity moderated significantly in February 2022, driven mainly by a contraction in the net foreign assets of the banking sector relative to an expansion in net domestic assets. Annual growth in broad money supply moderated to 17.7% in February 2022, compared with 29.1% in the corresponding period of 2021. This was reflected in slower growth in currency outside banks and total deposits. Similarly, annual growth in reserve money declined considerably to 21.9% from a growth of 34.8% over the same comparative period. Credit to the private sector continued to recover, consistent with the rebound in economic activities. In nominal terms, annual growth in private sector credit increased significantly to 17.1% in February 2022, compared with 7.4% in the same period of 2021. In real terms, private sector credit grew by 1.2% relative to a contraction of 2.7% over the same comparative period. The latest credit conditions survey revealed a tightened credit stance on loans to enterprises. However, demand for credit by households and small and medium-sized enterprises are projected to increase in the near to medium term. Developments on the money market broadly showed rising interest rates across the entirety of the yield curve. Over the period December 2021 to February 2022, the 91-day and 182-day Treasury bill rates have inched up to 12.8% and 13.3% respectively in February 2022. The respective rates in December 2021 were 12.5% and 13.2%. The rate on the 364-day instrument also went up from 16.5% to 16.97%. The rate on the 3-year bond increased from 19% to 20.5%, while that of the 2-year and 5-year bond remained unchanged at 19.75% and 21% respectively. The weighted average interbank rate inched up from 12.68% in December 2021 to 12.96% in February 2022. The increase in the rates at the interbank market level was transmitted to the retail end of the market, resulting in average lending rates of the banks inching up marginally to 20.52% in February 2022 from 20% recorded in December 2021. On the capital market, the Ghana Stock Exchange Composite Index recorded a gain of 43.7% in 2021 relative to a loss of 14% in 2020. For the first 2 months of the year, the index has recorded a loss of 3.3%. The year-to-date loss has been driven by a variety of factors to include the reimposition of capital gains taxes on securities listed on the GSE, which is inducing some investors to switch to government securities. Other factors include selling pressures, poor performance of some companies, relatively higher yields on fixed income securities, and uncertainty introduced by inflation and exchange rate pressures, as well as some portfolio reversals. Developments in the banking sector over the first 2 months of 2022 show continued strong asset growth. Total assets stood at 187.8 billion Ghana cedis in February 2022, representing a 23.5% annual growth, compared with 18.5% growth in the previous year. The growth in assets was on the back of increased deposits and borrowing. Total deposits recorded a year-on-year growth of 18.2% to 123 billion Ghana cedis. Borrowing also increased significantly by 78.8% to 25.5 billion Ghana cedis, relative to the contraction of 23.4% in the previous year. The rebound in credit growth continued in the first 2 months of 2022 with a 70.7% increase in new advances to 8 billion Ghana cedis, compared with a 24.6% growth in the same period last year. Trends in the financial soundness indicators remained positive, underpinned by strong solvency, liquidity, and profitability. The capital adequacy ratio of the industry was 19.6% at end February 2022, well above the current 11.5% regulatory minimum threshold. Core liquid assets to short-term liabilities was 24.2% in February 2022, compared with 26.5% in the previous year. Improvements in asset quality continued into 2022, with the non-performing loans ratio declining to 14.4% on average at the end of February 2022, compared with a ratio of 15.3% in February 2021. Bank's profitability improved over the first 2 months of 2022, with profit before tax estimated at 1.3 billion Ghana cedis compared to 1.1 billion Ghana cedis in the same period last year. Net interest income grew by 10.3% to 2.2 billion Ghana cedis, compared to 10.9% a year ago. Net fees and commissions grew by 11.8% to 486.8 million Ghana cedis, lower than the growth of 13.7% registered during the same period last year. Other income of the bank stood at 383.2 million Ghana cedis, representing a 95.5% growth, compared with a contraction of 16.5% in the same period last year. These developments resulted in a 16.9% growth in operating income to 3.1 billion Ghana cedis, compared with the growth of 8.7% in the corresponding period last year. However, operating expenses went up by 21.3% on account of higher administrative costs and emoluments, relative to a contraction of 0.3% in the same period last year. On the external front, commodity prices have increased sharply, driven in large part by ongoing geopolitical tensions and increased demand pressures. Average crude oil prices increased by 25% on a year-to-date basis to $93.5 per barrel in February 2022. The sharp rise in prices was supported by supply restraint and political tensions between Russia and Ukraine, which added to concerns about further disruption in an already tight market. Gold also gained from the escalating tensions as demand for the safe haven metal increased. Gold prices rose by 3.3% in the year to $1,849.5 per ounce in February 2022. Cocoa prices rose to $2,659.5 per ton in February 2022, compared to the $2,545.9 per ton a month earlier, as concerns about dry weather conditions boosted prices. While commodity prices have impacted exports positively in the first 2 months of the year, its impacts on imports have outweighed the gains made in exports and has led to a narrowing of the trade surplus. Total exports amounted to $2.7 billion, a growth of 5.5% year-on-year, compared with $2.6 billion as at February 2021. The jump in export receipts was driven mainly by a 35% increase in crude oil exports, benefiting from price effects as volumes declined. Other exports, mainly non-traditional exports, also registered an increase of 27.2%. Consistent with the pickup in economic activities, imports grew by 7.9% to $2.3 billion, compared with $2.2 billion the same period last year. The growth was reflected mainly in oil and gas imports, primarily refined petroleum products, which went up by 80.1% year-on-year. The developments in exports and imports translated to a lower trade surplus of $404.9 million in the first 2 months of 2022, compared with $432.7 million in the first 2 months of 2021. Looking ahead, these trends, together with developments in the services and income account, will likely result in a widening of the current account deficit by the end of the first quarter. The Russia-Ukraine war is likely to impact negatively on Ghana's external sector, particularly in the area of some key construction and agricultural commodities. In the recent past, an average of about 2.5% of Ghana's total non-oil imports have originated from Russia and Ukraine, and around 0.4% of Ghana's total exports are destined to Russia and Ukraine. The main import items from Russia are grains, wheat flour, and fertilizers. In 2021, around 28.7% of Ghana's grain imports came from Russia, and for the first 2 months of 2022, grain imports from Russia accounted for 31.2% of the total grain imports, and about 50% and 39.2% of flour and fertilizer imports, respectively, were sourced from Russia in the first 2 months of this year. Ghana's main exports to Russia are cocoa beans and products, and it accounted for just 0.2% of total cocoa exports. Ghana's major imports from Ukraine are iron ore and steel, accounting for over 60% of total iron ore and steel imports. As a result of this fact, the construction industry will likely face some challenges in terms of supply disruptions and prices of steel and iron ore imports. With regards to exports, manganese is the major item exported to Ukraine, and for the first 2 months of this year, manganese shipment to Ukraine accounted for around 12% of the total manganese exports. Over the past few years, manganese exports to Ukraine has accounted for over 20% of total manganese exports. Gross international reserves at the end of February 2022 stood at $9,547.96 million, providing cover for 4.3 months of imports of goods and services. This compares with $9,695.2 million, equivalent to 4.4 months of import cover at the end of December 2021. There was increased volatility in the foreign exchange market during the first few months of the year, driven by demand pressures from offshore secondary market activities, corporate sectors, oil importers, and weakened sentiments due to the downgrade by the rating agencies. These factors tightened forex liquidity, which was partly eased by regular foreign exchange auctions and inflows from mining and remittances. Cumulatively, the Ghana cedi depreciated by 14.6% against the US dollar and 11.6% each against the pound sterling and the euro in the year to 15th March 2022. In summary, the committee noted that the global economy has entered a period of profound uncertainty and fragility. The Russia-Ukraine war has introduced new uncertainties which have complicated the outlook and aggravated the COVID-related supply bottlenecks, elevated inflation expectations, and triggered higher crude oil prices, compounding the already high global inflationary pressures. Global financing conditions have tightened as key central banks raised policy rates to counter rising inflation. The combined effect of these developments could lead to further downgrades in global growth projections, increase investor uncertainty, and lead to capital outflows from emerging and frontier economies with weak fundamentals. Domestic growth conditions are fairly strong, despite signs of weakening consumer and business sentiments. The steady increase in private sector credit growth has continued with positive growth implications. Banking sector performance remains strong, with sustained growth in total assets, investments, and deposits. Key financial soundness indicators such as profitability, liquidity, and solvency remain healthy. Asset quality improved slightly, although there are upside risks to the outlook, requiring continued monitoring to address early signs of stress within the sector. The sovereign credit rating downgrades of Ghana by Fitch and Moody's led to widened yield spreads on both cedi-denominated Government of Ghana bonds and the country's euro bonds. These downgrades reflect market and investor concerns about fiscal and debt sustainability. Consequently, the Ghana cedi has come under severe pressure as offshore investors exited positions in domestic securities at a time when the domestic demand for forex has increased, reflecting both real and speculative demand. This has caused the exchange rate to overshoot its long-term trend. The strengthening of the US dollar, liquidity pressures, uncertainties regarding budget implementation, portfolio reversals by non-residents, and some speculative pressures are key contributory factors. At this MPC, the combination of tighter global financing conditions, sharp pressures on the exchange rate, and elevated inflation pose some policy challenges. Headline inflation has risen sharply to 15.7% in February 2022, and both headline and core inflation are significantly above the upper limit of the medium-term target band. The uncertainty surrounding price developments and its impact on economic activity is weighing down business and consumer confidence. The risks in the outlook for inflation are on the upside and include petroleum price adjustments and transportation costs and exchange rate depreciation. The bank's latest forecast still depicts an elevated inflation profile in the near term, with inflation falling within the medium-term target band within a year. Fiscal policy implementation has come under strain, reflecting embedded rigidities in the fiscal framework, which will require extensive structural reforms to free fiscal space to restore both fiscal and debt sustainability. Revenue performance has been slow to align with projections, while expenditure remains rigid downwards, despite strong efforts to cut expenditure by 20% as announced by the government. The above has resulted in financing constraints, which would have to be resolved very swiftly to ensure the announced fiscal consolidation path is achieved. The MPC is, however, confident that the ongoing discussions would lead to very decisive policy reforms that will address underlying fiscal mismatches and restore some calm in the markets. This, together with a monetary policy decision and additional measures, should help re-anchor inflation expectations. Under these circumstances, the committee has decided to increase the policy rate by 250 basis points to 17%. In addition to the upward policy rate adjustment, the Bank of Ghana will, effective 1st April 2022, enforce the following measures in relation to the universal banks. The cash reserve ratio is increased to 12%. The capital conservation buffer is reset to the pre-pandemic level of 3%, making the capital adequacy ratio a total of 13%. And the provisioning rate for loans in the other loans exceptionally mentioned category is reset to the pre-pandemic level of 10%. Thank you.